It seems like you just can't go one day lately in any line of work without hearing something about mortgage rates. And this is going to help you make sense of it all. I'm Tolley and you're watching Keaton PA. If you're looking to buy a home this year, you're probably paying close attention to mortgage rates. And since mortgage rates impact what you can afford when you take out a home loan, and affordability is a challenge today, it's a good time to look at the big picture of where mortgage rates have been historically compared to where they are now. Beyond that, it's important to understand their relationship with inflation for insights into where mortgage rates might go in the near future. So let's give some context to the sticker shock. As you can see, Freddie Mac has been tracking the 30-year fixed mortgage rate since April of 1971, and every week they release the result of the primary mortgage market survey, which averages mortgage applications data from lenders across the country. Looking at the right side of the graph, mortgage rates have increased significantly since the start of last year. But even with that rise, today's rates are still below the 52-year average. And while that historical perspective is good context, buyers have gotten used to mortgage rates being between 3 and 5%, which is where they've been over the past 15 years. That's important because it explains why the recent jump in rates might have you feeling sticker shock even though they're close to the long-term average. And while many buyers have adjusted to the elevated rates over the past year, a slightly lower rate would be a welcoming sight. To determine if that's a realistic possibility, it's important to look at inflation. The Federal Reserve has been working hard to lower inflation since early 2022, and that's significant because as the graph shows historically, there's been a connection between inflation and mortgage rates. Looking at the left side of the graph, each time inflation moves significantly, shown in blue, mortgage rates follow suit shortly after, shown in green. The circled portion of the graph points out the most recent spike in inflation, with mortgage rates following closely behind. And as inflation has moderated a bit this year, mortgage rates haven't yet made that similar move. That means if history is any guide, the market is waiting for mortgage rates to follow inflation and head back down. It's impossible to accurately predict where mortgage rates will go for sure, but moderating inflation means mortgage rates going down in the near future would fit a well-established trend. The bottom line is, to understand where mortgage rates may be going, it's helpful to look at where they've been in the past. There's a clear connection between inflation and mortgage rates, and if that historical relationship holds true, the recent decline in inflation may mean good news for the future of mortgage rates and your homeownership goals.